Hello students, I'm back to you all with the next video on sample question paper, which is consisting of 3 marks questions. So let's begin the journey of a 3 marks question paper solving. Begin with problem number 17. Now, Anshul, Babita, and Chandir, so these are the 3 partners in a firm running a successful business of car accessories. They had agreed to share profits and losses in the ratio 1 by 2, 1 by 3, and 1 by 6, respectively. After running business successfully and without any disputes for 10 years, Babita decides to retire due to old age, and Anshul and Chandir decides to share the future profit and losses in the ratio 3:2. So the previous ratio was 1 by 2, 1 by 3, and 1 by 6. That is and the present ratio will be 3:2. That means the previous ratio was 3:2:1, and the present ratio will be 3:2. The accountant passed the following journal entry for Babita's share of goodwill and missed some information. Fill in the missing figures in the journal entry. Now, here, the first entry that they have done in the journal is Anshul's capital account debit, Chandir's capital account debit to Babita's capital account, and the amount that over here they have written is 21,000, and missing is this figure and the total figure. So, being Chande's a share of goodwill debited to the account to continuing partners in their gaining ratio. So, we are going to find out this two figures, missing two figures. We are going to find this out. Now let's move on to the solution for this question. So what we see is we have to find out the gaining ratio first. So when we find out the gaining ratio, the formula will be new ratio minus old ratio. That is, Anshul's gaining ratio will be 3 by 5 minus 3 by 6, that is 3 by 30. And Chander's gaining ratio will be 2 by 5 minus 1 by 6, that is 7 by 30. So this will be the gaining ratio, that is 3:7. Now Chander's share of goodwill is equals to Babita's share in goodwill by divided by number of times Chander's gaining share, that is 21,000, which is already given in the question. See, this Chander's capital was already provided in the question. So 21,000 equals to Babita's share in the goodwill into 7 by 8. 7 by 10, sorry. 7 by 10. And Babita's share of goodwill, so from this equation we can solve it, that is 30,000 is coming the answer. So Anshul's share, we can therefore find out if the total is 30,000 minus 21,000, that we can also get as 9,000, or we can also do this as 30,000 into 3 by 10, that is a share, that comes to 9,000. So the final journal entry, the missing gaps that were there is 9,000 and 30,000. So these two are the answers to your question. Now let's move on to problem number 18. Here we can see that P, Q and R are partners with fixed capital of 40,000, 32,000 and 24,000. After distributing the profits of rupees 48,000 for the year ended 2022 in the agreed ratio of 3:1:1, it is observed that the interest on capital was provided at the rate 10% per annum instead of 8% per annum, and the salary of rupees 12,000 was credited to P instead of Q. So these are the mistakes that has been done. you are required to pass a single journal entry in the beginning of the next year to rectify the above omissions. So the answer to your question will be P's capital account debit 11,648, R's capital account debit 96, to Q's capital account 11,744. Now, how we got this, that we will be looking into first. That is, it has been said that if we see the question, the fixed capitals are 40,000, 32,000, 24,000. So the interest on capital at the rate 2%. Why 2%? Because 10% and 8%, the gap is 2. So we have to reduce the interest on capital. So it is said that interest on capital paid is 2% excess, that is 800, 600, and 480 if we calculate respectively in the perspective of how much capital they are having. The salary that has been credited wrong is to P 12,000. See, in the question it says that salary of 12,000 was credited to P instead of Q. Next, we have a payable. That means we have to subtract this. Payable, that is 1152, and payable for interest was 384 and 384. So salary payable to Q was 12,000. So what we see is extra payment has received to P as 11648, and deficiency of 11,744 for Q, and excess has been received by R 96 rupees. So therefore, the equation stands as P's capital account debit 11,648, R's capital account 96, and Q's capital account 11,744. So this is the final journal entry, of which this is the working note. Now next we move on to problem number 18, or here the question says that cheese and slice are equal partners. Their capital as on 1st of April 2022 was 50,000 and 1 lakh respectively. After the accounts for a financial year ending 31st March 2023 have been prepared, it is observed that the interest on capital at the rate 6% per annum and salary to cheese at the rate 5,000 per annum was provided in the partnership deed has not been credited to the partner's capital account before distribution of profits. You are required to give necessary rectifying entries using profit and loss adjustment account. So the solution to this question will be profit and loss adjustment account debit 9,000 to cheese capital account 3,000 to slices capital account 6,000. How is this coming? Let's just have a look once. So here we can see that 50,000 and a 6%, if we calculate, we get 3,000, and over here we see 1 lakh and we have a 6% once again, so we get a 6,000. So 3,000 cheeses capital gets credited, and 6,000 gets credited to slices capital, because these are the interest on capitals that has been omitted earlier, which is now being provided. So the entire thing goes to the profit and loss adjustment account, because it has been said in the question that you need to provide rectifying entries using profit and loss adjustment account only. Now next is salary that has been omitted earlier but now provided. It has been said in the question that salary to cheese is 5,000, which has been per annum, which has been provided but not credited. So the entry will be profit and loss adjustment account debit to Cheese's capital account 5,000. So the salary has been omitted earlier but now provided. We just have a quick check. We will be looking into it that it is 3,000 over here and 5,000 over here. So 3 and 5, that is Cheese's capital, will be debited 8,000, and in Slice's capital we will have 6,000, which has been debited over here. So the total sum total of these two gives us 14,000. So this is the final entry. So this is the major entry that you need to keep concern at. Now, problem number 19, next sum, that is Pioneer Fitness Limited took over the running business of Healthy World Limited, having assets of 10 lakhs and liabilities worth rupees 1,70,000 by issuing 8,000 8% debenture of rupees 100 each at a 5% premium, redeemable after 6 years at the rate 110, that is 10% profit, and check of rupees 50,000. So pass the journal entry in the books of Pioneer Fitness. So the first entry will be as per the question demands. 10 lakh is the assets as given over here, and 1,70,000 is the liabilities. So we will be writing, just see over here, assets account debit 10 lakhs and liabilities worth rupees 1,70,000. We will be writing over here first. This place and this place, we will not be writing any figures over here. We will be doing the next entry, that is Healthy World account debit, and we will leave this place as blank. We will be first writing the entry, that is Healthy World account debit, loss on issue of debenture account debit, 8% debenture, 2 securities, 2 premium on redemption, 2 bank, and we will be writing these entries, that is 8% debenture account 8 lakhs. How? Because in the question you can see 8,000 into 100, that is issuing 8,000 debentures of rupees 100. We will be writing securities premium 40,000 because it is given over here 5% premium. We will be paying, so we will be writing over here 40,000 as the securities premium account amount. Premium on redemption account will be 80,000 because here we are having 8,000. Here we are having 8,000, and over here we are having a 10 rupees buffer, that is 100 minus 110, that is in case of redemption we will have to pay, that is 8,000 into 10, that is 80,000, and that figure only we will be writing over here in loss of issue of debenture. And in bank we are having to write 50,000 as given in the question. That check of rupees 50,000 will be given by the company. So we will get this figure and we are having this figure. So by subtracting, we get this figure as 8,90,000. We will be then writing it back over here as 8,90,000, and we will get a total over here and we'll subtract it and we will get this figure, that is 60,000. So the net journal entries will be asset account debit 10 lakhs, goodwill account debit 60,000, two liabilities 1,70,000, two Health World Limited account 8,90,000, and the second entry will be Healthy World Limited account 8,90,000, loss on issue of debenture 80,000, 8% debit to 8% debenture 8 lakhs, to securities premium 40,000, to premium non redemption 80,000, to bank account 50,000. Next we move on to problem number 19. Or Lilly Limited forfeited 100 shares of rupees 10 each issued at 10% premium, that is 8 rupees called up, on which a shareholder did not pay rupees 3 on allotment including premium and first call of rupees 2. Out of these, 60 shares were reissued to Ram as fully paid for rupees 8 per share and 20 shares to Suraj as fully paid up at the rate rupees 12 per share at different intervals of time. Prepare share forfeiture account. So here if we see the answer, then we will see that the answer will be to share capital account 120, to reserve to capital reserve 120, to capital reserve once again 80, and to share capital 400, that is the balance is coming as rupees 40. So the entire thing we are getting from this question, that is 100 shares, 10 rupees at 10% premium, 8 rupees called up, and 3 rupees allotment including premium, first call of rupees 2, out of which 60 shares, 8 per share is reissued to Ram, 20 shares to Suraj, 12 rupees per share at different intervals, and we have prepared this as the share forfeiture account. Now, problem number 31. Classify the following items under the major heads and subheads in the balance sheet of the following of a company as per Schedule 3 of the Companies Act. Loose tools. Loose tools will come under current assets, that is subheading inventories. Uh, Next, as per your question, is loan repayable on demand. Loan repayable on demand, that is, it comes under current liabilities, short-term borrowings, provision for retirement benefits, non-current liability, long-term borrowings, premium, prepaid insurance, current assets, other current assets, it will be the subheading because it's not directly current asset but a current asset also. Next is capital advances, non-current assets, that is long term loans and advances, and shares in listed company, non-current assets, or rather non-current investments. Next, we move on to problem number 32. A company, please note, a liquid ratio of 1.5, current ratio of 2, inventory turnover ratio, that is ITR, of 6 times, total current asset of rupees 8 lakhs, annual sales if the goods are sold is 25% profit on cost. Calculate the debt to capital ratio, capital employed ratio from the following information, that is 15 lakhs shareholders fund, 8% debenture will be 7 lakh 50,000. Very sorry, this 8% will be for debenture, it has gone up, it's a printing mistake. Next, we have current liabilities as 2,50,000, non-current assets as 17 lakh 50,000, and current asset as 7 lakh 50,000. So the solution to this question is current ratio is current asset by current liability. This is already known to us. So we have current ratio as per the question 2. So therefore 2 equals to 8 lakhs, which is current assets by current liability. That is, we have current liability is 4 lakhs. Then we have liquid ratio as per the question is 1.5. So 1.5 equals to liquid assets by 4 lakhs, that is 6 lakhs liquid assets. Inventory equals to current asset minus liquid asset, that is 8 lakh minus 6 lakhs, that is 2 lakhs. In ITR, that is the inventory turnover ratio, equals to current ITR, that is the inventory turnover ratio, equals to cost revenue from operations by average inventory, that is 6, equals to cost revenue from operations by 2 lakhs, that is cost of revenue from operations is 12 lakhs. So therefore, finally, we can see that the gross profit is equals to 25% of cost, that is 3 lakhs. Revenue from operations is equals to cost of revenue from operations plus gross profit, that is 12 lakhs, plus 3 lakhs, that is 15 lakhs. And debt to capital employed ratio is debt by capital employed, that is 7,50,000 divided by 7,50,000 plus 15 lakhs, that is 7,50,000 by 22,50,000, that is debt to capital employed ratio is 1 by 3, or always debt to capital ratio is written in is to, so therefore 0.33 is to 1. And if you have liked the entire video, then please like, comment and share so that many of your friends can get the solutions to the questions that they are having problems at. And also please subscribe the channel so that you can keep getting more notifications on more accounting and accounting sums and accounting sample papers as they're coming soon. Thank you all. So we will be waiting for the next video, which consists of 4 marks questions. Let's just give me a bit of time to just upload the next video. Thank you.